news. So there's a lot to digest. Let's bring in one of our favorite guests, Karl Schamotta. He's Chief Market Strategist at Corpay, and he is ready, willing, and able to talk all things Bank of Canada. Karl, we are at this moment less than 40 minutes away from this decision. What are your expectations for today?
Right. I think I'm aligned with virtually everyone else out there in expecting that we do see a cut. However, I think the interesting part here is what comes in the accompanying communications in the monetary policy report and in the post-decision press conference. If I'm reading the tea leaves correctly, the bank does want to provide additional accommodation right now, but they don't want to get markets and consumers into a place where they expect back-to-back cuts at the remaining meetings this year. So, what we could see here is a little bit of caution, a little bit of emphasis on the recent acceleration in core price pressures that we've seen, and a warning that, that there are upside risks ahead for the Canadian economy, including, what happens in global markets as well as what happens in the Canadian housing market. So, what we could see is something of a hawkish cut, if that makes any sense.
Sure. Well, we try to make as best sense as we can. It's never easy to turn central bank speak into simple to understand language. Nevertheless, it's not an easy game that any of the central bankers are involved with right now. So let's go through a couple of things you talked about. First of all, on inflation. Now, I started the show by saying there were some encouraging trends on inflation, but you correctly pointed out that if you look closer at the inflation numbers, there's still some trickiness out there. Are we talking about an environment with sticky inflation that doesn't make this a slam dunk for central banks like the Bank of Canada to say, okay, inflation, the fight is over, away we go, cutting interest rates?
That's right. I think the worry here is that we could see a bit of a reacceleration, something like the U.S. saw earlier this year. Not that, the long-term trend is all that negative or scary, but just enough to give central bankers pause, right? To let them know that there are some underlying price pressures that could, derail that easing trajectory in the future, right? And so why is all of that happening? Well, really, it seems to be a lagging impact coming from what's happening in the services sector, wages continuing to rise, which is a positive phenomenon, as well as the interest rate impact from the bank's own decisions, right? So all of that sort of combining to mean that the trajectory for inflation is not a linear downward trajectory, right? We don't know for sure that we're going to see sequential declines in inflation going through the autumn months. And as a result, it makes sense to kind of take a meeting by meeting sort of cautious approach to easing, and also to making sure that communications don't lull people in the markets into sort of a sense of complacency about where the bank might go in the future.
Okay, on the flip side, one might point to some worrisome signs for the economy. Maybe they'll look at the current level of the unemployment rate. It's north of 6%. A lot of times people come on and they say, hey, that record population we've seen in Canada? Well, guess what? The growth of the economy is simply not keeping pace with the number of people that now live in this country. That is a worrying sign. And I mentioned that point about what's happening in the housing market. There were all these people who wondered after that first cut if it would lead to a flood of activity into the housing market. And that didn't seem to be the case, Karl. You can correct me if I'm wrong. And I mentioned that in the mortgage world, you still have to ultimately price a lot of products based on what's actually happening in the bond markets itself. Walk us through your thinking on some of those topics or all of those topics.
Yeah, so, fundamentally, I think the Canadian economy is in trouble. We are seeing a slower tempo of activity. The consumer is clearly reaching exhaustion, and that is transmitting across a whole lot of sectors. It does mean that that the Canadian dollar should be lower in the long run. It does suggest that interest rates should be lower in the long run. However, there's a bunch of other factors that do come into play. So, for example, if we think about the employment rate, that has traditionally been a great sort of signal telling us where we are in the business cycle. But with that immigration gain, we don't actually know. It could potentially be that we're not absorbing those new migrants to Canada quickly enough But we're not seeing the sort of rate of layoffs that is typically associated with a downturn. On the housing side, if we look at the latest consumer survey from the Bank of Canada, what it's showing is that Canadian consumers essentially expect home prices to go up at the same pace that they were going up prior to the pandemic hitting in 2020. And so, that sort of suggests to me that despite these sort of affordability headwinds, despite the cost of capital, that the underlying psychology behind the housing market hasn't shifted as materially as you would think.
Okay.
And so all of that to me means that you have to be careful if you're a policymaker at the Bank of Canada. You have to make sure that you don't, sort of reinvigorate those animal spirits to such a great degree that we see a renewed round of speculation.
Karl, we're almost out of time, but your wheelhouse is the currency. I want to get to that right now. I mentioned that we've been trading below 73 cents U.S. There's a lot of people who think we could be on a path of divergence in monetary policy compared to the United States that becomes the widest in decades. Tiff Macklem has fielded a number of questions. I mean, I've asked him about it on what happens if you see a deterioration in the loonie because Canada's cutting interest rates on a weakening economy, and does that complicate a whole host of things, including our fight against inflation? What are you going to be watching closely when it comes to the currency itself?
I don't think much of that all matters, to be honest. I think at the end of the day, rate differentials are holding relatively stable. So over the next 3 years, the Bank of Canada and the Fed are expected to move at relatively similar paces. So, this is not driving rate differentials super wide, not exerting drag on the currency. And the Bank of Canada has a lot of room. The history shows that a decline in the currency does not necessarily transmit into a huge rise in inflation. And so I think what they're going to do is continue to set policy in accordance with their views on domestic fundamentals, and they're going to let the currency take care of itself.